operate our business. And by the way, a nonprofit's no different than a for-profit company in that context. They're businesses, they're just businesses who have a little bit different way of looking at the money that's going, and they're taxed differently. Okay? So now we have net profit after taxes. You know, I just say this for information. One of the things you'll see is the balance sheet, the income statement, the statement of cash flows, they're all different, but they all kind of hook together. They touch each other in different points. Okay? So when I have a profit, or even a loss, you know, my net profit finds its way onto my balance sheet in the area of retained earnings. We'll talk about what that is when we get to the balance sheet. But all of a sudden, my profit showed up on the balance sheet. That's interesting. There it is. Oh, we took some of the profit in the unit of U.S. currency, because profit, you don't pay bills with profit, do you? Anybody pay a bill with profit? I never have. You know, hey bank, you know, I'm going to write you a check for $1,000 of profit. They go, we're taking currency this week. Thanks, Greg. We're taking U.S. currency. Okay? So if you write a check to the owners, you pay it because you put some money in. Maybe it's the opportunity for the business to finally pay you back a little bit. You write a check to yourself, not payroll. You got to payroll, but let's say just a check out of your profit in the form of cash. We'll call it a distribution or a dividend. You know, dividend's another term. Sometimes when we talk about publicly traded companies, we use the term dividend. We talk about privately traded companies, we talk about distribution. Just two words that mean the same thing. So, hey, where does that show up? Oh, it shows up over on my statement of cash flows. Oh, okay, so I see how profit ended up on the statement of cash flows. Okay, that's not something I would expect you to remember. It's to illustrate the fact that these are linked together and they have connections. Okay, I think my next slide is balance sheet, right? Yeah, I think so. Any questions about an income statement? We went through this fairly quickly, but you know, it follows that convention of sales minus cost of goods sold equals a gross profit, minus operating expenses equals an operating profit or loss, minus other income or plus or minus other income, profit before taxes, taxes. Okay? If you understand that kind of basic construct there, then tomorrow look up General Motors or look up IBM, and there it'll be, just like that. It'll follow the same format. All right? Any questions? No? Oh, dang it. I thought I knew what my next slide was, and I was off by one or two. You didn't reveal that to me either. You set me up. Okay. This is an important point, though. This is an important point because it gets to the issue of profit and cash. Now, I've got a slide way at the end that distinguishes those two, but I want to talk about this because it's real important. On your income statement, you're going to have one or two items that we're going to call non-cash items. Non-cash items. Now, you think about your expenses. You probably wrote a check for all your expenses, didn't you? I wrote a check. The utility bill was $1,000. Wrote a check. Rent, $1,000. Wrote a check. Labor, wrote a check. Payroll, wrote a check. Materials, wrote a check. Wrote a check. Wrote a check. Okay? And we got this thing called depreciation. It's right there on the income statement. Anybody ever write a check for depreciation? I know I haven't. I haven't. What the heck is depreciation? Well, it's a simple concept. I just want to land on it for a moment and then move off of it, but to make sure you understand, what role it plays in profit, loss, and cash. Depreciation is simply a process by which a capital investment, not the investment in an asset, like the investment in a truck or a machine or a building or copy machine perhaps, or things, big investments. We'll just leave it at big investments for now as a general term. Investments, we get to, the whole idea is I get to spread out the cost of that investment more or less over the useful life. And more or less is a really loose kind of definition, but more or less over the useful life. And generally the IRS gets to say what the useful life is. So let's imagine I need a pickup truck for my business, and I buy a truck for $10,000, pickup truck for $10,000, and the IRS says you can depreciate the truck for 5 years, to make the math easy. Well, when I bought my truck, how much was my check that I wrote to the dealership? $10,000, right? $10,000. But the IRS says I can spread that expense out over 5 years. So the expense in the year I bought the truck is what? $2,000, 1/5. And then the expense in the next year, when I didn't buy the truck, because I bought it the year before, is another $2,000, and another $2,000, and another $2,000, and another $2,000. So I get to show that $10,000 truck not as a $10,000 investment, but as 5 $2,000 investments. So you can see that I wrote a check for $10,000, but I only showed $2,000 of expense. And then I'm showing this $2,000 expense in years that it really wasn't. I wrote no checks in years 2 through 5. Okay, so you get that concept. Spreading the value out over kind of what is thought to be the useful time. Because the expectation is that truck or machine or whatever I bought is going to provide income to my business too. That's what I bought it for. I bought it to create value. So I'm going to get some income, I'm going to get some positive benefit off of that truck. That's going to show up in years 1, 2, 3, 4, and 5. I'm certainly not going to get $10,000 worth of benefit in the first year. I'm going to probably get 1/5 of the benefit in the first year, and then another fifth, another fifth. So that's depreciation. Understand that it is, when we look down those expenses, we pay U.S. currency for most of the expenses that we've listed there, except depreciation and amortization. What's amortization? Again, the easy way I remember it, it's the things you can't touch. So depreciation are items that are tangible in nature, and amortization is kind of the equivalent of things that are intangible, patents, and a concept called goodwill, which we're not going to talk about, but they're squishy, intangible things, generally.
What's the benefit to putting $2,000 in your balance sheet instead of $10,000?
In your income statement? Again, the benefit would be, theoretically, the benefit is that the benefit of that asset is going to occur over time. So I'm kind of matching up my income with my expenses. The idea is I don't want to, I'm not going to load up my income statement with all of the expenses, because let's take it out of $10,000, let's call it a $500,000 machine that I plan to use for 7 or 10 years. Okay? I'm going to have $100,000 worth of expense this year, but I'm going to get the benefit of that for 10 years, theoretically. So it's to kind of match up the benefit with the cost of that benefit, to kind of even it out. Otherwise, I end up with $100,000 of expense this year, which could really, $500,000 rather of expense this year, which could create a big loss situation. And then next year, I create some big, or we'll say for the next 5 or 6 or 7, 10 years, I create profit situations because I don't have that expense anymore. Now,
that's what happens.
That is what happens. That is what happens. We're not going to talk tonight about accrual or cash accounting. There's 2 different methods of accounting. They are both correct. They're both accurate. They're both allowed. One is called cash accounting. The other is called accrual accounting. And you treat some of the things you're talking about differently in cash accounting. At home, we run a cash accounting system. When I write a check, it shows up as I wrote the check. When I deposit my check at the bank from my employer, it shows up then. We record it when it happens. Accrual accounting is different. And then I'll say this and I'll kind of, I won't go any further. Accrual accounting is when I send the bill to my customer, I get to count it as sales. Even though my customer may not pay me for 30 or 60 or 90 days, I get to count it today, even though I don't have the money. It looks like I have the money, I don't have the money. Same thing, when I get my electric bill, I put it in the system as if I paid it today. I'm not paying it today. I'm paying it 30 days from today.
So you use depreciation in accrual accounting?
Well, you use it in other. It's a tax convention too. The IRS allows you to pay your income taxes, using depreciation to spread that out. Not everything makes sense it makes sense in this, but to understand the rationale I mean, the rationale makes sense to me. The IRS's rationale for why they chose the years and the periods they did, and we'll see other things when we get to the balance sheet. We talk about market value and book value. That book value and market value won't make, well, it'll make sense, but you go, well, why would they do that? It's because the way it's done.